All right. Well, good evening, everyone, and we'll get started at 6 o'clock. So we'll try and be punctual tonight. But welcome to, I guess, what is technically our third week for public budgeting this summer. It's kind of strange that since we didn't have class last Monday for Memorial Day, it seems like a long time since we've been together. But this is technically week number 3 for public budgeting. So welcome back. We do have to play a little bit of catch up this week, obviously, since we didn't have class last Monday. So the way I have tonight envisioned is the first half of class, we will do budgeting processes. We'll talk about the federal budget process and then talk about how that kind of frames our discussion then of state and local budgeting processes as well. And the way in which we'll handle it is as I talk about different features of the federal budgeting process, I will then talk about similar features or sometimes dissimilar features of the process in the state of California. So we can kind of see how both the federal as well as the state process works kind of concurrently with each other. So we'll do that in the first half of class tonight. We'll then take a break, and then the second half of class, we'll talk about different budgeting formats, and I'll introduce you to 4 primary budgeting formats, and I've got some examples to show you of what each one of those budgeting formats looks like. If we have time remaining after we talk about budget formats, we may be able to get into a little bit of analysis and budgeting. We'll see how we're doing with time. Analysis and budgeting is kind of about an hour, hour and a half discussion. So if we don't have much time left tonight, then we'll hold off on that for next week. And then next week do analysis and budgeting and capital budgeting and debt management. But we have plenty of time built into the class. We'll be able to cover all of the topics on our schedule without much issue. Thank you for your beach board essay number 1. I've gone through all those that have come in and responded to those and graded those. I think everyone did a fine job, so no issues there. Again, you were just identifying a couple of the major priorities in Governor Newsom's budget and then how those priorities may have changed or shifted as a result of the May revise. And again, the whole purpose of the exercise was just get you familiar with what the California budget looks like, what some of the major priorities in the budget are, because as we talked about last week, a budget really is a statement of societal priorities. And so if we really want to see what a society values, we need to take a look at what they put their money behind in the budget versus what's not in the budget or what gets a lower level of appropriations in the budget. And hopefully you kind of were able to see that in the governor's budget. And then secondly, we really want to emphasize that kind of unique feature in California budgeting known as the May revise, and how the May revise really can substantially change the California state budget and change some of our priorities. We really thought going into the May revise that because of the fallout from the COVID-19 pandemic, we would have a reduction in state revenue. What we actually saw in the May revise is we had an increase in state revenue. So rather than having to cut back on programs, we actually were able to augment those programs. We're actually able to put more money into a rainy day fund, and it was a much more positive budget picture after the May revise this year. Now, as we go through a discussion of the budgeting process, one of the things we'll emphasize here in the state of California is the importance of these things called trailer bills. And so you took a look at the governor's budget. You saw the May revise. You have the parameters of what the budget looks like in California moving into the next fiscal year, which will begin on July 1st. But everything is not finished once we begin the new fiscal year on July 1st, because here in California, we have a series of what we call trailer bills. And those trailer bills will then spell out for us specifically how the money in the budget will be spent. And so you don't really know exactly how the money's being spent and how the programs are being implemented until you really get a good sense of those trailer bills. And those trailer bills are going to be trickling out of the state legislature in July and August. So sometime in August, once this class is already done and over with, obviously, we'll have a much better idea of what these programs are going to look like and what the spending parameters are going to be for the California state budget for the next fiscal year that begins on July 1st. But at least as a result of Beach Board Essay number 1, you got a general sense of some of the priorities in the California state budget. Now, next Sunday, June the 12th, you've got a couple of assignments due. You have Beach Board Essay number 2, and not only that, but also, as you know, a response to at least one classmate. In Beach Board essay number 2, what you're going to be looking at is you're going to be looking at budget format. So you're going to take some of the information we're going to talk about in the second part of class tonight, and you'll apply it to do Beach Board essay number 2. So for Beach Board essay number 2, you're going to be using the city that you're using for your pre-instructional assignment, talking about what type of budget format the city is using, and then if you had to recommend a different budget format, what type of budget format would you recommend, and why would you recommend that alternate budget format? And again, tonight we'll present 4 main budget formats that will cover pretty much the totality of the types of budgets used by most of the local governments here in Southern California. So you got Beach Board essay number 2 due on Sunday. Then you also have your pre-instructional assignment due as well. And I know several people have already turned in their pre-instructional assignment, and I've reviewed it and provided feedback to you. Again, on that pre-instructional assignment, you're just answering those basic 8 questions for your city's budget. If you're not able to answer the questions, you don't have the information yet, you can just simply say, I do not have the information to answer the question. Again, do the pre-instructional assignment without access to any of the information from the class, and then we're going to redo that when we get to the post-instructional assignment part 1 at the end of the class, which is not that far away, just a few weeks away at this point. Okay. So those are the 2 things that you have due on Sunday. Any questions or anything before we get into budgeting processes in the first half of class tonight? Okay. I'll just kind of foreshadow this a little bit by letting you know that when we talk about budgeting processes, we're going to frame everything around the federal budget process, with the recognition that the federal budget process is highly complex. And it is so complex that we cannot do it justice in an hour or an hour and a half of class time. We couldn't do it justice if we taught in an entire class for an entire semester on the federal budgeting process. You could have an entire degree program on the federal budgeting process and still probably not cover all of the nuances. I think, as I mentioned last week or 2 weeks ago, there are some folks who have served in Congress for a very long time. We know that there's some people who have served in the Senate for 20, 30, 40 years. And even those folks who have served for a generation or 2 in the Senate still don't know all the ins and outs and all the nuances of the federal budget process. It is that complex and sometimes that convoluted. But what we're going to do is just with very broad brushstrokes tonight, kind of sketch out for you how the federal budget process works, how it's supposed to work, and some of the reasons why it doesn't work the way in which it's supposed to. Again, to serve as a guide for us to understand how budgeting goes on at the state and the local level as well. So the goal tonight is not to make anyone an expert on the federal budget process. I don't know if that is even possible, if there is anyone who knows everything about the federal budget process, but just kind of sketch out in broad brushstrokes the way in which the process works, just to use it as a guide. Now, usually, regardless of whether we're talking about budgeting at the federal level, at the state level, or at the local level, we typically have 4 different phases or 4 different cycles to the budgeting process. And the 4 different phases are preparation, formulation, implementation, and then audit and evaluation. Preparation is where we put the budget together. We kind of estimate and put together our forecast of how much revenue we're going to have to spend, how much it's going to cost us to keep our current level of service provision in place for the next year. This is where we kind of get all our ducks in a row, if you will, to get ready to put the executive budget together. That's what we refer to as preparation. We'll go through what goes on in preparation in just a second. Once the budget goes to the legislative body, whether it be Congress at the national level, whether it be a state legislature at the state level, that's where we shift from the first phase of preparation into the second phase known as formulation. So we talk about budget formulation phase, we're talking about the work being done by the legislature, either Congress or the Assembly and the Senate here in the state of California. But in preparation and formulation, we're putting the budget together before the fiscal year begins. Then when the fiscal year begins, which at the federal level is October 1st, Here in the state of California, it's July 1st. Whenever that fiscal year begins, that's when you shift from formulation into the third phase, which is implementation or execution. This is where we're actually spending the money. And as we'll see, there are a lot of decisions that need to be made, even in the implementation and execution phase. So even when the budget is done and we're going out there and spending the money, we still have a lot of decisions to make about who spends the money, how they spend the money, and all the implementation-oriented types of decisions. So implementation and execution, that phase is going to last through the fiscal year. So at the federal level, October 1st to September 30th. At the state level here in California, July 1st until the following June 30th. Then once the fiscal year expires, that's when we move into the fourth phase, which is the audit and evaluation phase. This is where we go back and we look at how we spent the money. We make sure we spent the money in the legally appropriate ways in which we are required to spend the money. We'll also look at how well we spent the money and do things called performance management-based audits. We'll make sure that we are spending the money in the most expeditious way possible. But audit evaluations, we go back and we look at how things happened in that preceding fiscal year and then reach conclusions that will inform how we will do these things in an upcoming fiscal year. So those are your four basic phases of your typical budgeting process. So let's break each one down and look at what goes on in each specific phase of the process. So preparation is our first phase. Again, in preparation, we're laying all the groundwork to determine how much money we have to spend, where that money is coming from, what we're going to spend that money on, how much money do we need to spend in order to maintain our current level of service provision. So last fiscal year, we provided a certain level of services. So we provided services to X number of Americans in this program. If we were going to serve that same number of Americans in the next fiscal year, how much additional would it cost us to do that? Because as we know, money is time-based. And so doing something this year will probably be more expensive for us than it cost us last year. And we're all painfully aware of inflation that we're dealing with now and these price increases. It's always become more expensive to do things in future years. And this year, it's much more expensive to do things than it was last year. So we need to put together these forecasts and these estimates. In the preparation phase, two of your primary players are what's called the Office of Management and Budget, otherwise known as OMB, as well as the Congressional Budget Office, or CBO. OMB, the Office of Management and Budget, serves the president. So it's an executive level organization. It is housed within the executive office of the president, and the job of OMB is to basically serve as the central clearinghouse to put together the president's executive budget to then be transmitted to Congress. OMB, in doing its work, will put together a lot of different estimates and a lot of different forecasts. One of the most important estimates that it puts together is this document known as the Current Service Estimates. OMB will estimate for the next fiscal year, how much will it cost us to do what we did last year? How much additional money will it cost us? So it gives us an idea of how much more revenue we need for the next fiscal year. The Congressional Budget Office is kind of the counterbalance, the counterweight to the Office of Management and Budget. Congressional Budget Office is a legislative organization. It was created by Congress in the 1970s, and it serves at the pleasure of Congress. So the purpose of the Congressional Budget Office is to provide budget information to Congress to counterbalance some of the budget information that OMB is providing to the president and to the White House. CBO is probably best known for its document known as the Baseline Budget Projections. And its baseline budget projections, CBO will project, here's the amount of revenue we can anticipate getting in the next fiscal year. Here's how much it's going to cost us to do our programs in the next fiscal year. And we'll use a somewhat different methodology than OMB uses to arrive at its current service estimates. So you kind of have these two organizations working in parallel to each other, using different methodologies and oftentimes arriving at different results. So sometimes you'll see one budget picture come out of OMB and a completely different budget picture coming out of CBO. Now, here in the state of California, we have corollary organizations to OMB and CBO. Here in California, the corollary organization to the Office of Management and Budget is our Department of Finance. So the California Department of Finance is responsible for putting together budget forecasts and budget estimates for the governor's office. The corollary organization here in California to the Congressional Budget Office is what we call our LAO, our Legislative Analyst Office. And the LAO then does some work here in California that's somewhat similar to the role that CBO plays for Congress at the federal level. So just like at the federal level here in California, we have these two, I don't want to say competing, but we have two different organizations that sometimes do produce some competing results in terms of their forecasts and their estimates. So the question that becomes, if you've got two different organizations and they're coming up with different types of results to inform the budgeting process, which organization's projections are more accurate and less biased? Now, accuracy and bias are two terms that are different. They are related to each other, but they are measured differently. Accuracy of a forecast or an estimate is simply measured by taking the forecast and then comparing it in the future to what actually happened. So we say we're going to get X million dollars in revenue for the next fiscal year. Then when the next fiscal year ends, how much did we actually generate? And the difference then between our forecast and what we actually generated, our actual as we call them budgeting, that difference is in a measure of accuracy. So the first question is, how accurate are OMB and CBO in making their projections? For the most part, they're both relatively accurate. And we can compare the forecasts and the estimates that come out of OMB and CBO to what some private organizations do. And if you compare what goes on with these organizations to private organizations, you're going to see some very similar levels of accuracy. So we're usually pretty good in terms of accuracy. The difference between OMB and CBO is more in terms of bias. Now, the difference with bias is that bias has a plus or minus sign. So with accuracy, we're just talking about how close is our forecast to what the actual. In bias, we're asking, does that forecast overestimate or underestimate where we actually ended up with our actual amounts of revenue? So it's got that directionality, that plus or minus sign. This is where we see a difference between OMB and CBO. OMB tends to be much more optimistic, I guess you would say, in terms of its revenue projections. There's something in budgeting referred to as rosy scenario. And rosy scenario is when you paint a prettier picture of revenue than what's actually going to happen. OMB is well known for rosy scenario. They tend to paint a better picture of revenue than what actually does happen. CBO tends to be a little bit more conservative in terms of their estimates. Here in California, it's a similar type of situation where the Department of Finance oftentimes tends to be a bit rosier and a bit more optimistic with revenue projections than the Legislative Analyst Office. And I think that difference in terms of bias really is something that is kind of baked into the organizations and what they do and who they serve. OMB and the Department of Finance serve a chief executive. And so obviously they want to paint a pretty picture for that chief executive to try and help that chief executive get their proposals passed and to try and get their initiatives in place. CBO and the Legislative Analyst Office are legislative organizations. They serve a legislative body that's made up of many different people. And so, at the federal level, we're talking about 535 members of Congress. In California, we're talking about 120 different state legislators. And so they're serving a broader group of people who have a broader set of goals and objectives. And so they have to kind of play it a little closer to the vest. And so they tend to be a bit more conservative with their projections. But at the federal level, you got OMB and you got CBO, and they're going about their business. You also have some other organizations like the Joint Committee on Taxation. They're going to be doing their own forecast for revenue as well. But OMB has an added responsibility. In addition to putting together these current service estimates and their forecast, they are also the central clearinghouse for the president's budget. So what they will do is they will put out a call for budget requests to all the agencies and all the departments and all the commissions across the entire federal bureaucracy. It's what used to be known as Circular A-22. That's what they called their budget request. So they put out this call for budget requests, and then every department and agency then puts together their budget requests, sends those budget requests off to OMB. If you remember a couple of weeks ago, we talked about agency heads and some of the ways in which they strategically misrepresent their budgetary needs. Well, this is where this strategic misrepresentation happens. If you need 2% for next year, you may ask for 4 or 5%, because you know full well whenever your request goes to OMB, OMB is probably going to cut your request. So they're going to cut that request back. You're going to lose some of that money. And so you got to have this contentious relationship between the agencies and OMB. But OMB cuts these requests, these budget requests, and puts all these reduced budget requests together into the executive, the presidential budget. That usually gets wrapped up in late January. And so about the time that the president goes and usually does their State of the Union address, where they address Congress, a joint session of Congress, by then the budget's pretty well crafted, it's pretty well put together. And then by the first week in February, typically, the president will then release the budget. And the budget then goes to Congress and then gets released to the public. When that happens, we then shift from our preparation phase into the formulation phase, because then the ball shifts into the court of Congress, and then it's up to Congress to try and work with that presidential budget to put together the final budget for the next fiscal year. Now, whenever the president used to release their budget, it was a big media event, and they would literally have boxes and box on top of boxes of thousands of pages of the federal budget. Members of the media would then be called into the White House, and they would pick up their physical copy of the budget and carry their boxes out and then go through it page by page. Obviously, today we don't do that anymore. It's all done electronically, but it's still a pretty big event whenever the president delivers their budget to Congress. Now, for newer presidents, they kind of get a little bit of a break. And so maybe if you watch the Biden administration, the Biden administration didn't deliver their budget to Congress until much later than the first week in February, because new presidents kind of get that break in the timetable. But once you got a couple years under your belt as president, your budget is expected to arrive in Congress by the first week in February. Then that first week in February, when the president's budget hits Congress, we then begin the second phase, the formulation phase of the budgeting process. The way in which the process works, formulation works, is when the president's budget goes to Congress, it has a centralized starting point known as the Budget Committee. There is one Budget Committee in the House of Representatives. There is another Budget Committee in the U.S. Senate. The president's budget goes to the House Budget Committee and the Senate Budget Committee, and it's the job of the House and the Senate Budget Committee to pass this thing called a budget resolution. And today we refer to it as the concurrent resolution on the budget. That is supposed to be done no later than April 15th. And it's not a coincidence that it happens to be April 15th, the same day that federal income taxes are due. Congress was very mindful of that when they set that deadline. But the concurrent resolution on the budget, an agreement between the House and the Senate budget committees, that concurrent resolution has to be done by April 15th. What that concurrent resolution on the budget does is it sets the maximum spending limits for all the different spending categories within the federal budget. So say here is X amount of money that can be spent on agriculture programs. X amount of money can be spent on health and human services. X amount of money can be spent on education, X amount on Veterans Affairs, X amount on Homeland Security, and so on, commerce, treasury. So across all your different spending areas, we'll set spending caps in this concurrent resolution on the budget. That is meant to try and impose some fiscal discipline on Congress so that Congress knows the limits, its spending limits, that it needs to work within as it crafts the budget for the fiscal year. So that's the job of the budget committees in this concurrent resolution on the budget. Then the way the process is supposed to work is once that concurrent resolution on the budget is passed and we have these spending limits in place, then the scene shifts to the appropriations committees. There is one appropriations committee in the House and there is one appropriations committee in the Senate. Each of these appropriations committees then will have 12 separate subcommittees, and each appropriations subcommittee will work on a different functional area of the budget. So you'll have an agriculture appropriations subcommittee, Health and Human Services appropriations subcommittee. Those subcommittees will then hold hearings. They will mark up the appropriation bill within their spending area, which means make amendments and make changes to it. The subcommittee will then pass that appropriation bill. Once the subcommittee passes it, it then goes to the parent appropriations committee. And then the appropriations committee itself will then hold its own hearings, do its own amendments and its own markups, and will then pass that appropriation bill to then go to the floor of either the House or the Senate. Now, that's true. These appropriation bills are true for a type of spending known as discretionary spending. So for the most part, we're really simplifying it a lot, but there are two basic areas of spending in the federal budget process. There's what's called discretionary spending and what's called mandatory spending. Discretionary spending is for programs that Congress has direct control over. So if Congress can change the funding level directly through legislation for a program area, then that program is referred to as discretionary spending, and that spending is then found in these appropriation bills that are passed by the subcommittees and by the House and the Senate appropriation committees. So that's for discretionary spending that Congress has direct control over. Then there's a second category of spending known as mandatory spending that Congress does not have direct control over changing. So examples of that would be mandatory spending, things such as interest on the national debt. Once Congress borrows money, that money needs to be repaid. They need to make principal and interest payments on the money they have borrowed. They don't have direct control over those interest payments. They need to make them unless they call the issue in, call the note in, and they refund it. They're going to have to pay those interest payments. So they don't have direct control over it, thus making it mandatory type of spending. Another big example of mandatory spending is spending done on what we call entitlement programs. And we hear a lot of rhetoric, a lot of talk about entitlement programs and how entitlement program spending is out of control and continues to grow. It's true that entitlement spending for most entitlement programs does continue to grow from one year to the next. But the reason why the spending grows is because more and more people become eligible for those benefits. So you can think of something like a social welfare program. Social welfare program will pay benefits to households that are legally entitled to those benefits. So households under a certain maximum income level are then legally entitled to these benefits. The more households that fall within that maximum income level, the more benefits you then have to pay in that entitlement program. Another example of an entitlement program we don't talk a lot about being an entitlement program is our good friend Social Security. Social Security, a lot of people think about it as, well, it's a retirement program, so it's a trust program, and so therefore the money I pay in goes into an account with my name on it until I retire. That's not the way Social Security works. Social Security is a redistributive program. And I think we mentioned this a couple of weeks ago. As a redistributive program, Social Security, what you're paying in today is going to benefit people who've already retired. And then whenever you are ready to retire and you retire, your benefits are going to be paid by people who are currently in the workforce today. So yes, it is an insurance program, but the money doesn't go into necessarily your account and sit there. It is redistributive. What you are paying in today as someone in the workforce, those benefits are paying for the Social Security benefits for someone who is already retired. But the important thing about Social Security with mandatory spending is that it is an entitlement program. So once you are vested in Social Security, once you have hit the required retirement age, you are then entitled to Social Security benefits. Congress cannot reduce spending on Social Security unless they change the eligibility levels. So if they say we want to spend less on Social Security, so we're going to raise the mandatory retirement age to 70 years old. Well, if you raise the mandatory retirement age to 70 years old for full benefits, you're going to reduce the number of people who are eligible because a lot fewer people are 70 and older. And so by reducing the number of people who are eligible to get benefits, you're reducing the amount of money you are spending in paying those benefits. So it's an indirect way in which Congress can affect the spending on an entitlement program like Social Security. Those types of mandatory spending programs that Congress does not have direct control over, those don't go through the normal appropriations process. They go through a separate process known as authorization. And so we have what we call authorization committees. And those authorization committees will then make those types of decisions about eligibility levels and whether or not programs should continue. That all goes through an authorization process for mandatory spending. So it's important to know we've got two different types of spending processes going on, discretionary versus mandatory in nature. Now, the discretionary spending, as we say, goes through appropriations committees because it has to go through an appropriations process. When you read the Constitution says that Congress may not remove money from the U.S. Treasury until it has first been appropriated. Appropriated is basically just a big word for saying how you are going to spend the money. So Congress must make it public. This is how we're spending the money before they're able to get access to those funds. That's what's called appropriations, and that's for discretionary spending. So the way in which the process was designed, we'll just focus on discretionary spending for now. The way in which the process was designed for discretionary spending is that these 12 different subcommittees pass out their individual appropriation bills, which then get passed by the House and the Senate Appropriations Committee, that then go to the floor of the House and the Senate for final consideration and passage. Now, the way in which budget bills, appropriation bills are handled is different than the way in which other legislation is handled. Appropriation bills in Congress are what are referred to as privileged pieces of legislation. And as privileged pieces of legislation, you can really limit the amount of amendments and whether there can be any amendments whatsoever during floor debate. You can limit the amount of debate that goes on when you're having debate on these bills. You can really put a lot of limitations on how the consideration process happens on the floor of the House and the floor of the Senate. But as you probably know from your undergraduate government courses, or maybe even from your PPA 500 course, is that the House of Representatives and the Senate are much different bodies. They operate much differently from each other. The Senate is a very egalitarian body, where every individual senator is considered to be, at least in theory, equal in power and prestige. Now, we know we've got some party leaders who wield a lot more power than other members of the Senate, but it's a very egalitarian type of body. The House isn't like that. The House, there are major power differences between leaders of the House and what we call the backbenchers. New members of the House who are brand new to the chamber will not have nearly as much power as those leaders of the House of Representatives. So the House is much stricter and much more regimented in the way in which it deals with budget information and budget bills, appropriation bills. Once the House Appropriations Committee passes this appropriations bill, Before it can go to the floor of the House, it must go through another step in the House of Representatives known as the House Rules Committee. And the Rules Committee in the House of Representatives will then establish the rules under which this bill will be debated. So they want very quick debate with no amendments. They'll pass a rule to that effect, saying you can't amend the bill. We're going to have very strict limitations on the amount of debate on the floor. The Senate, the Rules Committee doesn't do that. The Senate has a Rules Committee, but it has a completely different function. In the Senate, bills get to the floor through what's called a unanimous consent agreement, otherwise known as a UCA. A unanimous consent agreement means that each member of the Senate must agree before a bill can get to the floor. Now, it sounds difficult to get a unanimous consent agreement, but it's really oftentimes not that difficult because of a process in Congress that's known as log rolling. And there's this strategy in Congress referred to as log rolling, which is basically a quid pro quo. It's kind of a you scratch my back, I scratch your back. I'm not going to stop a piece of legislation that you're in favor of getting to the floor in hopes that you will then not stop my piece of legislation in the future from also getting to the floor. Now, there have been some notable exceptions to log rolling. Senator Rand Paul from the state of Kentucky recently has stopped several pieces of legislation from going to the floor of the Senate because he disagreed with them, and it was a way in which he could then negotiate changes before the bills got to the floor. But the Senate is a much different body than the House. So the House is much stricter, much more regimented. The Senate isn't. But there is this quirk in the Senate known as the filibuster. And you're probably familiar with the way in which the filibuster works. The filibuster is a way in which an individual member of the Senate can stop the consideration of legislation by just killing time. And so you can filibuster a bill by getting up on the floor of the Senate. And in the past, people have read from magazines. They've read from, back when we used phone books, the DC area phone book, just to kill time to stop the consideration of a piece of legislation. The way in which you break a filibuster, the way in which you can break a filibuster and keep a piece of legislation moving through the process in the Senate is through what's called a vote of cloture. I know we're getting into some of the specifics of the way in which the bodies operate, but it's important to understand how budgets get made. If you're facing a filibuster, you need to get a vote of cloture to break the filibuster and continue with the consideration of the legislation. A vote of cloture takes 60 members of the Senate. So you have to have 60 members of the Senate agree in order to break a filibuster and continue with the consideration of the legislation. Well, as you know, in the Senate today, we have an evenly split Senate. So much so that the vice president has had to come over and cast some tie-breaking votes because, you know, constitutionally, the vice president of the United States is also the president of the U.S. Senate, and the vice president gets to vote as president of the Senate only in the event of a tie. We've had a couple of instances of 50-50 ties where the vice president has come over and to cast a deciding vote. Since the Senate is so evenly split, that means you would have to get 10 people from the other party to agree with you in order to get a vote of cloture and to break a filibuster. That's what makes it so difficult to get legislation through the U.S. Senate. But there is a part of the budgeting process that was put in place several years ago that allows the Senate to avoid a filibuster. And that's a process known as reconciliation. So, go back to that second bullet point. When the budget committees in the House and the Senate were passing budget resolution, this concurrent resolution on the budget. In that concurrent resolution on the budget, as they're setting maximum spending amounts, they can also put in what's called reconciliation language for different areas of spending. So they put in reconciliation language, for instance, for certain types of education programs. That then allows them to, through budget reconciliation later in the year, to get around the filibuster. Because with those parts of the bill that have reconciliation language, you only need a simple majority to pass those aspects of the bill, as opposed to essentially needing to get 60 votes to break a filibuster. So what has happened in the past is at times the majority party in the Senate has put reconciliation language into the concurrent budget resolution to then allow them to pass certain parts of the budget through just a simple majority. We had that with the Build Back Better Act from last year. That was done under reconciliation because there was reconciliation language in that budget resolution. So reconciliation is a way you can get around that requirement for the agreement of 60 senators to break a filibuster in the U.S. Senate. Now, there is a way in which the budget is supposed to be done and the way in which the budget actually gets done. The way in which the budget's supposed to be done is you're supposed to have all 12 of these appropriation bills passed by the House and the Senate, and whatever the House version, the Senate version do not agree with each other. We then also know, based upon our reading of the Constitution, that you're not going to be able to send a bill to the president unless it's in uniform version for both the House and the Senate. So the House has an appropriation bill, and the Senate has an appropriation bill, and those two things are not identical in format. Then you have to have conference committees, and then you have to get together in a conference committee. You have to hammer out those differences, get a uniform appropriation bill that then goes back to the floor of the House and back to the floor of the Senate for passage before it can go to the president's desk for the president's signature. So a lot of these appropriation bills, they are in much different formats between the House and the Senate. So you got that conference committee process that you have to go through as well. But it gets, yes, the ACA, what in common colloquialisms referred to as Obamacare, it went through in that type of fashion as well. The problem, though, is that even with conference committees, and when you hammer out these differences, when that version of the bill then gets back to the House and the Senate, sometimes it's too late for the start of the new fiscal year. Because when you're talking about the formulation phase, Congress gets the president's budget the first week of February. It then must have those appropriation bills done by September 30th for the beginning of the new fiscal year on October 1st. So they don't have a full calendar year to work on this budget. They're working on it from the beginning of February until the end of September. Well, if you're not able to get all of this done, you can see all the moving parts so far in the process. If you can't get all these moving parts done and in place by September 30th, the federal government doesn't have a budget to begin the new fiscal year on October 1st. Most years, we are not able to get these 12 appropriation bills done by the beginning of the new fiscal year. It's extremely rare for us to do that. So what process has taken hold recently, if you will, is this idea of reconciliation. So instead, what Congress will do is October 1st comes and goes, and we still have, say, 5 or 6 appropriation bills that have not yet been approved by Congress and signed by the president. We will then, well, first we'll do what are called continuing resolutions. And so we will pass resolutions to just try and keep the government going in the new fiscal year. So they'll pass a continuing resolution. So say, for instance, education is one of those appropriation bills that has not been passed by September 30th. Congress will pass an Education Continuing Resolution Act. And that continuing resolution for education, they will say, we will fund the Department of Education for the next 2 weeks at 80% of what it was funded at for these 2 weeks last year. So it's a temporary stopgap measure. We're saying we'll give you 80% of what you had last year for these next 2 weeks to buy ourselves a little bit more time to get the education appropriation bill done. Once those 2 weeks have expired and that continuing resolution has expired, Congress will probably pass another continuing resolution. Say, well, we'll do it again for another 2 weeks while we still work on this appropriation bill. Those 2 weeks expire, they'll then pass another continuing resolution, and so on and so on. And this could drag on throughout the fall. And this could take us all the way through into the beginning of the new calendar year in January. We still won't have those appropriation bills passed. And so what Congress will do is it will then take all those unpassed appropriation bills and it will cobble them all together into a massive piece of legislation known as an omnibus, I'll put this in text chat, Omnibus Budget Reconciliation Act, otherwise known as an OBRA. And so there's a lot of legislation that has come through in the form of these Omnibus Budget Reconciliation Acts, these OBRAs. That's how we usually do the budget. It's not the way it's supposed to be done. It's supposed to be done through these different appropriation bills. The way in which it actually does usually get done is through an Omnibus Budget Reconciliation Act. That's the way in which we usually do it because the process, for lack of a better term, is broken. So sometime in December or January, Congress will panic and Congress will pass this huge, massive Omnibus Budget Reconciliation Act, and that will be the budget for that fiscal year. The problem with that is when we pass these Omnibus Budget Reconciliation Acts, they're literally thousands upon thousands of pages in length. We put so much into these OBRAs that we really don't know what's in them until we go back and read them a couple weeks later. And the reason for that is, again, log rolling. You need to get people to sign off on these OBRAs. So how do you do it? You do it by giving them their pet projects. Okay, so you want to have this bridge named after you, we'll put that in the budget. You want to have this building, construct this building, name it after you in your district, we'll put that in the budget as long as you approve the OBRA. And so it leads to a lot of what we refer to as pork barrel spending. And you've probably heard a whole lot about pork and pork barrel spending. Pork barrel spending is basically spending more than what we really need to spend for political purposes. So whenever you're a member of Congress, you want to bring home the bacon. You want to bring home all these projects to your district so you can claim credit for them. There's a very famous political scientist from many years ago named David Mayhew. And David Mayhew argued that one of the primary motivation of members of Congress is getting reelected. And one of the primary ways you get reelected is by claiming credit for things that you've accomplished while you were in office. Well, this is a way in which you can do it. So you throw all these different pork projects, if you will, into the budget becomes very large, and now you've got all this additional extraneous spending that you probably don't need to do in the first place. And that's the way we typically do budgeting at the federal level. It's not the way it's supposed to work, it's the way in which it actually does work pretty much every fiscal year for the past several years. But once you've got a budget in place, whether it's through passing the 12 appropriation bills or whether it's through an Omnibus Budget Reconciliation Act, once that fiscal year begins on October 1st, you then enter your third phase, which is implementation. This is where you actually go out there and you spend the money. Now, at the federal level, as we know, to pass legislation through Congress, one of the best ways to do it is by keeping that legislation as vague and ambiguous as possible. The more details you put in that legislation, the more likely someone will find something to object to. So if you keep it vague and ambiguous, you have a much better chance of getting a majority of members of the body to approve that legislation. Well, when this legislation, these appropriation bills are vague and ambiguous, someone has to fill in the blanks. At the federal level, that's oftentimes federal bureaucrats, public administrators, who during the fiscal year will then have to write the rules that will govern the implementation of these appropriation bills. Now, here in the state of California, filling in the blanks on all that budget bill that we get July 1st, the beginning of the fiscal year, that's oftentimes taken care of through what I said before, are what are called trailer bills. So all the language, or a lot of language, to help guide how this money should be spent and how this budget bill should be implemented, a lot of that language comes from these trailer bills that the state legislature will pass throughout the month of July and the month of August. So it's kind of a strange situation in California that even once the fiscal year begins, the state legislature is still making decisions about specifically how this money gets spent and what are the qualifications to receive these types of programs. We're still making those decisions as a state legislature a month or 2 months into the new fiscal year. But when you're spending the money in that fiscal year, that's what's referred to as the implementation execution phase of the budget process. And then once the fiscal year ends, so on September 30th at the federal level, on June 30th at the state level here in California. Once that ends, you then move into the audit and evaluation phase where you go back and you look at how you spent the money to make sure you spent the money in the legally appropriate manner. At the federal level, during audit and evaluation, and this year after the fiscal year has ended, there's a requirement that federal agencies and departments must submit what are called performance activity reports. And those performance activity reports, they have to report on how they spent the money and how spending this money helped them make progress toward achieving the goals of their organization. So they are held accountable. If they are not making progress toward their goals, they will not then be eligible for enhanced funding in the next fiscal year. So as of 2003, the Bush administration started to hold agencies accountable for how well they were spending the money. One very useful organization at the federal level during audit and evaluation is what's known as the GAO, the Government Accountability Office. It used to be called the General Accounting Office. Really, its role grew so much and became such an important organization that they changed its name to the Government Accountability Office. The Government Accountability Office, the GAO, is headed up by an individual called the Comptroller General of the United States. The Comptroller General in this Government Accountability Office will put together examinations and reports of federal programs. And literally, they will produce hundreds of reports every year on federal programs and federal agencies, how they spent the money, and how effectively they have been making progress toward the achievement of their goals. If you are interested, I think they still have this. I know they had this as of a year or two ago. If you go to the GAO website, you can actually sign up for a newsletter from the Comptroller General, where the Comptroller General will alert you whenever new reports are coming out. You can go and read those reports on federal programs. If you're doing any research into a federal program, I would highly recommend looking at the Government Accountability Office reports, because chances are for any federal program, they have done a study on it at least over the last 4 or 5 years. So we go and we do our audits. We'll talk about auditing next time, but there are different types of audits. There are what are called financial or legal audits that we do during the evaluation period. Legal or financial audits, we are asking, did the money get spent in the legally appropriate manner? So did it get spent in accordance with its appropriated intent? Then there's a second group of audits that are known as performance or management-based audits. In performance or management-based audits, we don't just ask how the agency spent the money, we ask how well did the agency spend the money. So you see, did this money enhance the performance of the organization and help the organization better meet the goals and objectives of the programs that it was implementing? So we do all those types of audits during this audit and evaluation phase. The important thing to realize is that you've got these 4 different phases to the budgeting process. You have preparation, formulation, implementation, and audit and evaluation. So 4 phases. Those 4 phases are going to span over a 3-year period of time, minimum of a 3-year period of time for the same fiscal year. And our fiscal years are going to overlap. So when you are in the implementation phase of a current fiscal year, you are in the audit evaluation phase for the preceding fiscal year. You are in formulation phase for the next fiscal year, and you may very well be in the preparation phase for the fiscal year coming up in 2 fiscal years. So all these different phases are overlapping on each other. We are dealing with many fiscal year budgets all at the same time, just in different phases of the process. That overlap of fiscal years in different phases of the process also contributes to the complexity of the federal budgeting process as well. So it is a very complex process, but it basically follows those 4 different phases that we laid out up to this point in time. Now, those 4 different phases in this federal budget process is not static. It is a very dynamic process, and it has changed a lot over the past several decades. And I don't want to delve too deeply into a lot of the reforms of the budget process, but I do kind of want to talk about where the different aspects of the budget process came from and why they came about. So we have already talked about in preparation this very important organization known as the Office of Management and Budget, the OMB. And we said the OMB serves the president, serves the White House. Primary job is to do these forecasts and these estimates, and also to put together the president's executive level budget. The OMB actually was created all the way back in 1921. It was referred to originally as the Bureau of the Budget, or BOB, back in 1921. In 1937, as a result of the Brownlow Commission and the reorganization of the federal government, the Bureau of the Budget was then placed within this new umbrella agency known as the Executive Office of the President. And as you know, in the 1930s, in the FDR administration, FDR was creating all these different agencies and all these different programs to try and deal with the fallout from the Great Depression, stock market crash and the Great Depression. Because FDR was creating all these new federal agencies and all these new federal programs, the federal government grew exponentially in the 1930s. And it became so difficult for the president to manage the federal bureaucracy that the Brownlow Commission recommended creating this new umbrella organization called the Executive Office of the President, and then to put all the management-oriented agencies within this executive office. Bureau of the Budget, as a management-oriented organization, was placed within the Executive Office of the President. There are other organizations in there as well. The White House office is in there. Also, Personnel Management is in there. Office of National Drug Control Policy is in there. Most agencies that have some type of management purpose are housed within the Executive Office of the President. Well, from its entry in the Executive Office of the President until the 1970s, the Bureau of the Budget started to take on more and more management functions until finally in 1970, we renamed the Bureau of the Budget as the Office of Management and Budget. And when Nixon did that in 1970, he was recognizing just how important the Office of Management and Budget was for managing the federal bureaucracy. It did more than just budgeting. It really did management as well, which is why it became the OMB. And the Office of Management and Budget, the OMB, is probably the most important agency in the entire federal budgeting process. It is so important because it provides an immense amount of information to the White House and to the president. So much so that in the 1970s, Congress became very jealous. And Congress felt that the president had all the information in the budgeting process and Congress had none. So Congress really wanted to make itself a co-equal with the president in the federal budgeting process. It wanted to centralize budget formulation within Congress. In the 1970s, when the president would deliver their budget to Congress, it would bounce all over the place. I mean, everybody would get their hands in the pie. Everybody would get a piece of the action. There was really no one centralized starting point for the president's budget. So Congress in the 1970s said enough is enough. We not only want to be a co-equal in the budgeting process, we want to have some rhyme and reason to how we go through budget formulation in the Congress. Also in the 1970s, Congress was very concerned about the presence of deficits. And we'll spend a lot of time next week talking about the difference between debt and deficits. But for our purposes now, a deficit is an imbalance in revenues and expenditures in one given fiscal year. So in one fiscal year, if you're spending more money than you're bringing in, you have a deficit. By 1974, we had run 5 consecutive years of deficits. We started running deficits in 1969, had them in 1970, 1971, 1972, 1973, and 1974. Congress became very worried that we were not balancing our books, and so they wanted to try and eliminate deficits. They were also worried because we weren't getting the budget done on time. They felt the process was really out of control. And so what we ended up doing, or what Congress ended up doing, is in 1974, they passed this thing called the Budget and Empowerment Control Act. And at the federal level, we are still in a budget. We're still in the deficit. We're still doing deficit spending. State of California, we are not. State of California, we have a large surplus. At the federal level, we have a large deficit. And the deficit has been continuing even after the passage of the Budget and Empowerment Control Act. So it's kind of interesting that you've got the federal government in one budget situation and the state of California in a much better budget situation. Now, some states are in dire straits in terms of their budgets, and they did not fare as well coming out of the COVID-19 pandemic as the state of California did. And there are a lot of potential reasons for that. Tax structure is one, in that here in the state of California, not to digress too much, but here in the state of California, our tax revenues are very heavily leveraged on the upper income wage earners in California. So your top 1% of wage earners in California pay a very large percent of income tax revenue here in the state of California. That's not necessarily true at the federal level, not necessarily true in some other states. And so the way in which you got it structured, a lot of the people at the upper income level, that 1%, they actually fared very well as a result of the pandemic. And so that brought additional revenue into the state. Also here in California, there is kind of more of a tradition of remote work that has been around for many years here in California, more of a technological type of focus than you have in some other states. That more technological remote work focus, I think, helped the economy keep going during the COVID-19 pandemic as compared to some other states that were much more industrial, much more manufacturing based, where if people weren't able to come to work, the factories shut down and they just weren't able to make product. And so, that's just a couple of reasons why California tended to do very well financially as compared to the federal government and other states around the country. But back in 1974, Congress decided we need to make some substantial changes to the federal budgeting process to try and accomplish these goals of making Congress a co-equal, centralizing the process in Congress, eliminating deficits, and trying to get the budget done on time. So just quickly, some of the things Congress did in this Budget and Empowerment Control Act in 1974. And you may think, well, this is something from 1974. Why are we talking about it in 2022? We're talking about it today because a lot of those reforms that were done in 1974 are still around today, and they still frame the budgeting process. And you'll still hear people refer to the Budget and Empowerment Control Act of the 1970s when they talk about today's budgeting process. So what did the act do? The act created those budget committees in the House and the Senate. So as we said, that's a central starting point: House Budget Committee and Senate Budget Committee. It introduced this idea of budget resolutions. Now, back in 1974, it created two different budget resolutions. It created a first budget resolution that was due in May and a second budget resolution that was due in September. The first budget resolution was non-binding. It was just a recommendation of how much money to spend. Then the second budget resolution that was due in September was a binding resolution that Congress had to adhere to. Now, subsequent to that, we've taken those two, we've combined them together, and we've squished them together into what we call the concurrent resolution on the budget. It created the Congressional Budget Office to serve as a counterweight to the Office of Management and Budget to, again, make Congress more of a co-equal in the process. It changed the fiscal year, so the new fiscal year would begin on October 1st and then on September 30th, the same federal fiscal year that we are still using today. It attempted to control what was called backdoor spending. This takes a quick bit to explain. Backdoor spending is a term that is used for any spending that occurs outside the appropriations process, but should occur in the appropriations process. So as we said before, you got two different types of spending: discretionary and mandatory. Discretionary spending should be going through the appropriations process. I mean, that's part of the Constitution. Any spending that is discretionary that does not go through appropriations is referred to as backdoor spending. And Congress wanted to get some control over that backdoor spending because you really want to do it through appropriations. So you're being upfront, you're being transparent about how the money is being spent, what the money is being spent on. And then Congress, also to exert its power a little bit, it wanted to try and control this process known as presidential impoundments. This will take a little explanation as well. What is a presidential impoundment? A presidential impoundment is when the president decides not to spend money in the appropriation bill that they sign. So Congress passes an appropriation bill and sends it to the president. Normally, we think the president's job is to sign that appropriation bill or to veto that appropriation bill. If the president vetoes the bill, it then goes back to the House and the Senate, and the House and Senate can override the presidential veto with a 2/3 vote of both the House and the Senate. So that's the veto process that is embodied within the Constitution. However, what presidents would do, and Nixon did a lot of this when he was in the White House, he would get an appropriations bill, he would sign the appropriations bill, but then for a program that he disagreed with, he would just refuse to spend the money. When a president refuses to spend the money in appropriations bill, that's referred to as a presidential impoundment. And there are two different types of presidential impoundments. The first type is not that dangerous. It's what's known as a deferral. So sometimes presidents will defer spending money for practical logistical reasons. And so the president will say, I'm going to sign the appropriation bill, but I'm not going to spend money on this program right now because I want to wait until income tax revenues come in. So I'm going to wait to spend the money until the revenue comes in to kind of, time my expenditures with my revenue. So I'm going to defer spending it for the next 30 days. That's not that important. That's not as concerning to Congress because Congress knows eventually the money will be spent. It's just going to be spent 30 days from now. That's a deferral. The type of impoundment that Congress really gets upset about is what's called a rescission type of impoundment, when the president rescinds funding. So the president then signs the appropriation bill, says, I disagree fundamentally and philosophically with this program, so I'm going to pick this program. I'm not going to spend that money for this program. I'm going to allow the spending for all the rest of the bill, but I'm going to not allow the spending on this program that I disagree with. I'm going to rescind the funding from this program. Well, Congress didn't like that because that sure sounds and feels a whole lot like a line item veto. And we know the Constitution does not give the president line item veto power. Now, a lot of governors, the vast majority of governors, have a line item veto in their state constitutions. So here in California, Governor Newsom has a line item veto. So he can go through and say, well, I'm going to approve the bill, but I'm going to veto out this specific line item. I'm going to veto out this specific line item of the budget. You can do that as a governor. You can't do that as a president. So in lieu of the line item veto, presidents like Nixon used this rescission type of presidential impoundment. So Congress wanted to make all these changes, again, mostly to try and increase its strength in terms of its competition with the president. Well, how did it work? It didn't work very well, even though most of the things created in the Budget and Impoundment Control Act are still with us today in our modern budgeting process. The act itself didn't accomplish its goals. Remember, its goals were to try and make Congress a co-equal, to try and centralize the process in Congress, to try and eliminate deficits, to try and control presidential impoundments, to try and get budgets done on time, to try and control backdoor spending. Didn't really accomplish many of those goals very well. First off, those two budget resolutions, the first one was non-binding, and that one, all it did, because it was non-binding, is it clued in all these interest groups that their programs were about to be cut. So basically what Congress did is it politicized the budgeting process even more by inviting all these interest groups to come to Congress to lobby them, because all these interest groups found out that in this first budget resolution, well, our program's going to be cut, so we better go lobby Congress. So it just made the process a lot more political. The second budget resolution, because it wasn't due until September 15th, just came too late in the process. So by the time you got that second budget resolution, you literally had 15 days left in the fiscal year. So because of that, we took the two, we squished them together, and we made them into a concurrent resolution on the budget due on April 15th. We still have that in place today. Well, how about impoundment controls? The way in which Congress is going to try and control presidential impoundments was through what became known as a one-house veto. So basically what Congress said is, if the president is going to try and rescind funding, then we as Congress can release that funding, with a simple majority vote in either the House or the Senate. So basically they're saying we're going to override that presidential empowerment with a simple majority vote in either the House or the Senate. It didn't have to be both, just one body. It was a one House veto. On the Chadha case, their case with the Supreme Court said, sorry, Congress, that's unconstitutional. The Constitution is very clear on how you override a presidential veto, and this is not the way to do it. So they found the limitations on presidential empowerments to be unconstitutional. Well, since they're unconstitutional, clearly they didn't work very well. Even the controls on backdoor spending, the controls on spending outside the appropriations process didn't work that well either, because Congress went and exempted the vast majority of the budget from those backdoor spending limitations. Up to 80% of the budget was exempt from those limitations. When you exempt 80% of your budget from any limitations, clearly those limitations are not going to be effective. So on item after item, the Budget Empowerment Control Act failed to accomplish its goals, but despite those failures, it still provides for us the framework for our modern federal budgeting process. We've got the concurrent budget resolution. We've got the House and the Senate budget committees. We have the fiscal year from October 1st to September 30th. All those innovations are still part of the federal budgeting process. But subsequent to 1974, we ranked deficits in 1975, 76, 77, 78, 79, 80, 81, 82. You get the idea. We kept running federal budget deficits, and every year, those federal budget deficits kept getting bigger and bigger and bigger until we get into the mid-1980s. We get in the mid-1980s, and Congress once again says we need to do something about deficits. So the goal in the 1980s was to try and control and eliminate deficits by creating what were called maximum allowable deficit targets. So every year we would set a deficit target. Here is the maximum imbalance between revenues and expenditures that we will tolerate in this given fiscal year. And so we'll set that maximum deficit target each year in this timetable. Every year in the timetable, obviously, that deficit target is going to go down until after a period of time, the maximum allowable deficit is zero, and we are now out of deficit spending. If in any one given year, Congress failed to hit its maximum allowable deficit target, a process would kick in known as sequestration. And this is your 25-cent word for the night, sequestration. Sequestration was a process whereby the president would then make across-the-board spending cuts to bring spending levels down in line with the maximum allowable deficit target. These across-the-board spending cuts in sequestration were meant to be so politically repugnant that nobody would want to go through sequestration. So they would have a built-in incentive to hit those deficit targets to try and avoid this politically painful process known as sequestration. This all came about in this piece of legislation known commonly as Graham-Rudman-Hollings, named after the three members of the Senate who co-sponsored the legislation. It was a bipartisan piece of legislation. Phil Gramm, a conservative Republican from the state of Texas, Warren Rudman, an independent from New Hampshire, and Ernest Fritz Hollings, a Democrat from South Carolina, got together and authored this piece of legislation known as Graham-Rudman-Hollings. That happened in 1985. Then there was a follow-up to that, a sequel in 1987 called Graham-Rudman-Hollings 2. Well, the question becomes, why do you need a sequel? Well, you need a sequel because Graham-Rudman-Hollings 1 didn't work. And not only didn't it work in reducing deficits, it also had this nasty problem that it was unconstitutional. So once again, we have Congress passing a law that Supreme Court then later finds to be unconstitutional. So we said we have the sequestration process. So if we miss our maximum allowable deficit targets, we'll go through sequestration. These across-the-board cuts initiated by the president. Well, the way in which Graham-Rudman-Hollings 1 was written, the Comptroller General, who, as we said before, is the head of the Government Accountability Office, that Comptroller General was placed in charge of presidential sequestration. So the Comptroller General was placed in charge of watching the president to make sure the president did sequestration appropriately. It basically was a watchdog of the executive branch. Problem there is the Government Accountability Office is a legislative organization. Ergo, the Comptroller General is a legislative employee. So they place a legislative employee in charge of an executive official, the president. It's a clear violation of separation of powers. And so in Graham-Rudman and Hollings 2, they had to take that provision out of the subsequent piece of legislation. Also, Graham-Rudman and Hollings 1 didn't work because we kept exceeding these maximum allowable deficit targets. So in a given year, if Congress wasn't meeting its target, Congress would just adjust that target. But we'll move it up and we'll change the timetable, we'll try again. Then the next year they didn't hit their target, well, we'll adjust it upwards, we'll try again. They kept readjusting the targets so that it was a failure in trying to eliminate deficits. By the time we get into the 1990s, our deficits are still there and they're getting bigger and bigger with each subsequent fiscal year. So up to this point, we have been a failure at trying to get rid of deficits. So we decided to try again. Congress is nothing if not persistent. And so in 1990, Congress passes this thing called the Budget Enforcement Act. The goal of the Budget Enforcement Act was to redirect our focus away from deficits and towards spending. So the grand idea was we were always focusing on deficits and it's not working. We still have these deficits year after year. So instead of focusing directly on deficits, let's instead focus on the root cause of those deficits, which is spending. If we spend less, then we'll probably have smaller deficits. Logical thought. So let's focus more on spending than deficits. By focusing on spending and reducing spending, we will in turn then end up eliminating those deficits. So what the Budget Enforcement Act did a couple of very important things that we are still using today. One thing it did is it created firewalls between three separate categories of spending: domestic, international, and defense. So we've got these three main categories of spending, and we're going to create firewalls between the categories, meaning that if you want to spend more money on domestic programs, you cannot take that money from international or defense. If you want to spend more on domestic, you need to find that money within the category of domestic programs. If you want to spend more on defense, you got to find it within your defense budget. You can't steal from domestic and international to pay for defense spending. So try to impose some fiscal control over how we were spending the money and where the money was coming from. And secondly, it introduced this idea known as PAYGO. PAYGO is an acronym that stands, kind of an acronym, it stands for Pay As You Go. Not a very novel idea in our personal financial lives, but a pretty novel idea at the federal level. Pay as you go. If you want to pay for an increase in an existing program, you have to do it by decreasing an existing program within that same spending category. If you want to create a new domestic program, you got to pay for it by either eliminating or reducing spending on another domestic program within that same category of spending. Pay as you go. So you can no longer borrow money to create new programs. You need to find that money in the current budget to pay for your new program for the next fiscal year. Now, why is PAYGO important? PAYGO is important because it has come and gone over the subsequent years. And so it kind of went away for a while. And then a few years ago, the Senate brought PAYGO back and reinstituted PAYGO, and then PAYGO went away again, and then they reinstituted it again. I believe it was 2 years, maybe 1 or 2 years ago, reinstituted again. So PAYGO keeps making a reemergence as part of our modern budgeting process. Then as a follow-up to that, in the 1990s, we ended up getting what were called Balanced Budget Acts. And so we got a Balanced Budget Act in 1993, another one in 1995, another one in 1997. And these Balanced Budget Acts consisted of spending cuts coupled with tax increases. And so we had a general energy tax increase in the 1990s. We know that when former President George Herbert Walker Bush ran for election in 1988, he said, no new taxes, read my lips, no new taxes. And then in his administration agreed to a somewhat modest, but still a tax increase that ended up, a lot of people say, ended up helping cost him the reelection in 1992. But we had some tax increase in the 1990s, spending reductions, and coupled with all of that, we had some pretty wild economic growth rates going on in the mid 1990s as well. We had the dot-com boom. And so we had the Silicon Valley just blowing up. We had all these dot-com companies. As they started really blowing up in terms of revenue, they were generating more revenue that brought in more income tax revenue for the federal government. So you combine all those three things together. Some general tax increases, reduction in spending, and economic growth rates, and in some quarters were close to 6 and 7% economic growth, which is pretty much unheard of. Combine all that together, by the time we get to the late 1990s, we had gotten out of deficit spending. And for 2 years there, in 1999 and in 2000, we were actually in surplus spending, where at least on paper, we were bringing in more revenue than we were spending as a federal government. That was the first time that had happened for 30 years, since 1969. Then, as we all know, September 11th happened, and when September 11th happened, we then went back into deficit spending, and at least at the federal level, we have been deficit spending ever since then. And yes, that happened during the Clinton administration, the very end of the Clinton administration. But a lot of that was, again, an accumulation of the Budget Enforcement Act, some of the increases in the Bush administration, along with that very quickly growing economy. At the very end of the Clinton administration, that's when we had surplus spending. Then as we moved into after September 11th, that's when deficits then reemerged. We're still running those deficits today, and we are still struggling today at the federal level trying to get the federal budget together in time. I did include a link on our Beachboard site that kind of shows you, takes you to a webpage, kind of shows you again the federal budgeting process in some broad strokes. But that's kind of the way in which the federal budget process works, some of the changes we made to that federal budget process that then will help inform what goes on at the state level. And we'll talk about state and local budgeting really quickly, then we'll take a break. I know we're kind of running long, and then we'll get into budget formats after the break. The federal level, the budgeting process, even though Congress has tried to reassert itself as a co-equal in the process, it is still a very executive-dominated process. The president puts together the budget and then transmits it to Congress. Congress, during formulation, must deal with the president's budget. So whenever the president can put together their budget, they're able to frame all of the budget questions. And then Congress has to work within that framework, thus making it an executive-dominated process. Most state budget processes are also executive-dominated as well. A couple of examples of executive-dominated processes. The state of Wisconsin, some will argue, has the most executive-dominated process in the entire country. California also has a very executive-dominated process in that the governor will put together their budget bill, and here's the difference. Instead of having appropriation bills, you have a budget bill. You have a singular budget bill that the governor will put together in January, transmit that to the state legislature. State legislature will hold hearings and will do their thing, but will not do a whole lot of serious work on the budget until the May revise. Here in California, we have that May revise, which is something you don't have at the federal level. That May revise, as you all saw in your Beachboard essay, can fundamentally change some of the spending in the governor's budget. So once the May revise comes in May, the governor will then revise that budget based upon that May revise, and then the state legislature will then consider those revisions as a result of the May revise. Then by June 15th, the state legislature is supposed to then pass the budget to be signed by the governor by June 30th for the beginning of the new fiscal year on July 1st. And as we said, throughout July and August, you then get your trailer bills for all the specific language of how the money will be spent and all the regulations to affect the spending of the money. But still executive dominated because it begins with the Department of Finance, it begins with the governor of California. Contrast that to what is typically going on in a state like Texas. Texas is a more legislatively dominated budget process. In Texas, they have this thing called the Legislative Budget Board, or the LBB. Legislative Budget Board is made up of leaders from the state legislature, and the Legislative Budget Board works together with the governor to put together the state budget. So at the very beginning, at the very inception of the budget, you have members of the legislature who are involved in the creation of that governor's budget, unlike Wisconsin, California, where it's more executive, gubernatorial driven type of process. Here in California, we have what we call our group of five. And so the governor, in combination with leaders from the assembly and from the state senate, those five individuals are really kind of the movers and the shakers once the budget goes to the state legislature in terms of what their final budget will look like when it's signed by the governor on June 30th in preparation for the new fiscal year on July 1st. And just quickly, a lot of people ask, well, why is Texas more legislatively driven? I think it has a lot to do with the historic political culture in Texas, whereby interest groups in Texas for many years have been very, very important. And whenever interest groups are very important, they really see more sway in the state legislature than they will see with the governor's office. And so that's why they have really promoted more of a legislative role in the inception of the gubernatorial budget in Texas, thus making Texas a much more legislatively dominated type of process. But here in California, we do tend to be very much of an executive-driven process. And also, as Jay says correctly in chat, a lot of states have part-time legislatures. Here in California, we're familiar with a full-time professional state legislature. A lot of state governments do not have that. They will have state legislatures that don't meet annually. They'll meet every other year. They'll do biennial budgeting. You'll have some legislatures across the country that they're very part-time in nature, where they'll make maybe $200 a day per diem for the 14 days that they're in session once every 2 years. And so you do have those differences, not only in governance, but in political culture, that really do end up manifesting themselves in different budgeting processes. But again, here in California, it's very executive driven, and a lot of the specifics of the budget will come in those trailer bills, and we'll have to hold off and see throughout July and August what those trailer bills say. I know, being on a school board for the past 6 years, it's frustrating for local governments because you really have to sit back and wait. Well, here's the governor's budget. What's great. This is the amount of money that's going to K-12 education. However, what are the stipulations for how that money needs to be spent? And you really can't go out and start spending that money until the trailer bills come through to tell you how to spend that money and what some of the limitations are. And that was true with a lot of that one-time COVID-19 relief money. There are very specific stipulations for how that money needed to be spent. You really couldn't go out there and spend it on anything except for those stipulated purposes. You didn't get those stipulated purposes until you got those trailer bills in July and August. And that is relatively unique here in California compared to a lot of other states. Well, at the local level, how the budgeting process works oftentimes depends upon the type of governance structure that local government has. Is it a strong mayor? Is it a weak mayor form of government? Is it a commissioner form of government? Is it what we call here in California a reformed government that has a city manager appointed by city council? The structure of government really has a big impact upon who takes the lead in doing the budget. Now, you're probably familiar with the differences between a strong and a weak mayor form of government. And as you know, in a strong mayor form of government, the mayor is elected independently of city council. So that mayor then has their own political power base. They oftentimes have a lot of say in the budget priorities when that budget is constructed at the local level. In a weak mayor form of government, the mayor comes from city council. So there are a couple different ways you can do a weak mayor form of government. Here in California, typically, the mayor position is done on a rotational basis. So you have your city council election, and then the city council on a rotational basis will then select a member from the city council to serve as mayor and another member to serve as mayor pro tem. And then the next year, they'll select another member of city council, and so on and so on. In some states, in a weak mayor form of government, the person who gets the most votes in the city council election, that person gets to be mayor. They're still a member of city council, but they get to wear the moniker of mayor. And I know in Cincinnati, Ohio, many years ago, if you are familiar with the TV personality Jerry Springer and the Jerry Springer Show, well, believe it or not, Jerry Springer was a member of the Cincinnati City Council several years ago. And as a member of the city council in a city council election, got the most votes and then became mayor, Jerry Springer, and actually served as mayor of Cincinnati. Well, in a weak mayor form of government, obviously the power is not going to reside in that weak mayor, the power is going to reside in city council. There are also what are called commissioner forms of government. We're kind of familiar with that here in California with our counties. In our counties, we have a board of supervisors. So you have 5 supervisors representing different areas. That's a commissioner form of government. So they have primary responsibility for passing the county budget. In a reformed system of government, you have a city manager that's appointed by city council, as you all know. Oftentimes, a city manager form of government, it's the city manager that oftentimes takes the lead, especially when it's a weak mayor city manager form of government. It's a city manager that takes the lead in putting that budget together and transmitting that budget to the city council. So as you take a look at your city's budget, one thing you'll see is there'll be a letter of transmittal for that budget. And you'll see who does that letter of transmittal. Is that letter of transmittal from a city manager? Is that letter of transmittal from the head of the Department of Finance? Is that letter of transmittal from a mayor? It'll kind of give you some clue in terms of who initiates the budget process, depending upon the type of governance structure that that local government has. So no, it's a lot of information up to this point in time. I realize that, but what I want to do is just kind of present to you, here's the budget process, especially at the federal level. This is what it looks like. It's kind of a guide for then understanding how it goes on here in California and at the local level. You know, we've got a few quirks here in California that other states do not have, like the trailer bills. Another quirk that we have, obviously, is Proposition 13. We'll talk a lot about that when we get to taxes. But we made a change to Proposition 13 not too long ago that now allows us to pass the budget in the state legislature with a simple majority. In the past, it required a supermajority. Now we only need a simple majority to pass the budget. However, if you want to increase taxes, you still need to get a supermajority. So if you want to balance your budget, and you have to do that through increasing taxes, you still need the supermajority. But just to pass the budget itself, you only need a simple majority. That has made it much easier to get budgets passed here in the state of California. But we'll get more into Proposition 13 and all those good little quirks when we get to taxation in a couple of weeks. I know it's past 7:30. I apologize. It took you a lot longer than I usually do. So let's go ahead and take a break. You can stretch your legs, whatever you need to do. Let's come back at 7:45, and we'll wrap this up, and then we'll get into a discussion of budget formats. I'll show you 4 of the main budget formats so you can kind of identify what type of format your city is using. So take a break to 7:45, come back, and we will do budget formats. Okay, well, welcome back. Just had to start the recording up again. Again, I apologize for how long the first half of class went, but again, it's a budgeting process, and so there's a lot of information to pack in. I want to make sure we got through all of it. So that's why it was so protracted of a first half of the class. But in the second half, what I'd like to do is, again, talk to you about some budget formats. And this will be information that obviously is something you can apply immediately to your budget that you're using for your city. I do ask that as you do your pre-instructional, if you haven't turned it in yet, I hope you've already talked about the budget format or written that section. Trying not to use too much of this information for the pre-instructional because it kind of defeats the purpose. But I do want to cover this information tonight just so that you have the information going into Beachport essay number 2. So you'll have the information you need to do that essay. So there are a lot of different budget formats that governments can use. I would like to focus on 4 main budget formats here in this class because these are the 4 budget formats that you're most likely to see used, especially at the state or the local level. And there are some others as priority-driven budgeting and envelope budgeting and others that we don't really cover because chances are you're not going to see them used, especially by local governments here in Southern California. So we're going to focus on 4 main budget formats: line item budgeting, performance-based budgeting, program-based budgeting, and then zero-based budgeting. Those are the 4 we're going to talk about tonight because they're kind of the universe of budgets that you typically see used here in Southern California. The way in which I like to do this discussion is to link up the budget format with the purpose that we're using the budget document for. And there's a famous budget scholar by the name of Alan Schick. And Alan Schick argues that there are three main purposes that a budget document can be used for. Budgets can be used for the purpose of control, they can be used for the purpose of management, or they can be used for the purpose of planning. When we use a budget for the purpose of control, we're using that budget document to try and control how much money we're spending and what we're spending that money on. So a budget document that emphasizes control will tell us the object of expenditure and the amount that's being spent on that object. So it's all oriented around controlling what we are spending. But a budget document can go beyond that as well. It can go beyond just allowing you to control your expenditures. It can help you manage your organization. So some organizations use their budget document as a management tool. And that's something that you can use with, for instance, a performance-based budget. So we'll incorporate information into the budget that will help us more effectively and more efficiently manage the operations of our organization. Then the third purpose you can use the budget for is a planning tool. So we use the budget to help plan the functions and operations of our organization. So we can use it as a tool in strategic planning. A budget that's used for strategic planning, an example could be a program-based budget or a zero-based budget. Now, what connects all three of these purposes together is as you move from the control to the management to the planning purpose, you are moving from a kind of simplistic approach to a more rational approach. The more rational you are being, the more you're using your budget for planning. The more simplistic you are being, the more you're using the budget just simply for control. So let's look at some of those four budget formats and link them back to these three purposes of control, management, and planning. So if you just want to use your budget for the purpose of controlling your expenditures, probably the most appropriate budget format to use is a line item budget. You're familiar with line item budgets in the exercise you're doing for part 2 of your post-instructional assignment that utilizes a line item budget. That Excel spreadsheet I provided for you in that exercise, that's a line item budget. So you list your object of expenditure, you list the amount that's being spent per unit, the number of units, and then the total amount that's being spent. So like you see in that post-instructional line item budget, you've got branch librarians, $34,000 per branch librarian, 6 branch librarians, and the total being spent across all 6 branch librarians. Reference librarian, the amount being spent per unit, so on and so on. Assistant librarians and so on for all of your objects of expenditure. You'll have supplies, and so you'll have your supplies listed as your object of expenditure, maintenance, utilities. Those are all the objects, and then how much money we're spending on each one of those objects. Clearly, it's oriented around control because we're controlling how much we're spending and what we're spending that money on. It's a very traditional type of budgeting format, and it really does lend itself to incrementalism. It really lends itself to making those small changes from one year to the next. And it lends itself to incrementalism and very small changes from one year to the next because all the information we have is how much we spent on each of these objects from last year. That's the only information we have in constructing next fiscal year's budget. So it's going to lend itself to those very small changes from previous years. The good thing about incrementalism and line item budgeting is you can avoid big mistakes. Because if you're just doing what you did last year and you're just making a small incremental change to how much you're spending on that object, you're not introducing new programs, you're not introducing new initiatives, so chances are you're not going to have any huge mistakes. However, you're going to be repeating small mistakes year after year after year. And so if the project or the program that you funded last year will naturally find its way into this year's budget, and if it's not being as effective as it possibly could be last year, that's not going to be effective this year either. And you'll have those small incremental mistakes that will reoccur year after year. The line item budget is by far the most common type of budget you'll see used by governments, especially at the local level. Just about every local government will have a line item component to their budget. And so you probably already looked at your city's budget. Your city will have some element of line item in their budget. Everyone does it. It's a very simple, very traditional, very quick and easy way to put a budget together. However, if you want to use your budget document more as a management tool and you want to incorporate some additional information into your budget, you can use a performance-based budget. And now these budget formats are not mutually exclusive. So you'll see a lot of local governments, their basic budget will be line item in nature, but then they'll add in some performance measures. And that then makes it a performance-based budget. So they'll combine the two, line item and performance-based budgeting, together into one budget document. With performance-based budgeting, you're doing just that. You are incorporating performance measures, performance indicators into your budget document. By including those performance indicators, you can then generate information that you need to better manage your organization. So some of your performance indicators could be the amount of hours that are being paid for with this expenditure. Could be the number of people who are being served by this program. An example I used to use that I know Mike so used to use in his textbook, in a city back east, they have a snow removal program. And so they put together a performance-based budget where they'll include indicators of performance, such as the number of miles of road that were plowed, the number of miles of road that were cleared using salt, because back east they use a lot of rock salt in order to melt the ice. The number of accidents in that stretch of road where snow was a contributing factor. The number of citizen complaints about the roads not being cleared of snow. All those are indicators of performance that can then be built into your performance document so that you can see if you have fewer citizen complaints this year than you had last year and you're spending the same amount of money, well, then obviously you're being more efficient, being more effective than you were last year. If you're serving fewer people this year with the same amount of money, you're being less efficient than you were being last year. So you can have that information built into your performance-based budget to help you manage the operations of your organization. So it helps to see whether or not and how well you're living up to your performance-based expectations. Now, performance-based budgeting has been around for a long time. Performance-based budgeting first came out in like the 1940s and the 1950s in the classical approach to performance-based budgeting. In the classical approach to performance-based budgeting, we focus on the outputs. We focus on the goods and the services that were being created. So in a classic performance-based budgeting approach for that snow removal program, you would look at the number of miles that were plowed or the number of miles where snow was cleared using salt. Those are outputs. Those are things that we are doing as an organization. That was classical performance-based budgeting. And that really caught on and was very popular in the 1950s, kind of went away for a few decades. And a lot of governments started to move away from it, but then returned to it in the 1990s in a new approach to performance-based budgeting. And in that newer approach, that more modern approach to performance-based budgeting that began in the 1990s, we shifted our focus away from just looking at outputs and we started looking at outcomes. We started looking at those consequences. So examples of consequences would be the number of accidents where snow was a contributing factor. That's a consequence of clearing the streets. Clearing the streets, that's the output. Reducing the number of accidents where snow is a contributing factor, that's the outcome. That's the consequence. And that's what the newer, more modern approach to performance budgeting really starts to focus on, those outcomes and those consequences. But that's performance-based budgeting. I'll show you an example of performance-based budgeting in just a second. But that really does highlight this management feature of a budget document. Then a third budget format you may run into, it's less likely you'll see this than you'll see line item and performance-based, is the third type, which is program-based budgeting. Program-based budgeting is a much more rational way of creating a budget document, and it really does start to highlight that planning feature more so than just control or management. Now, if your city is using a program-based budget, you will know that. You will see that very readily because a program-based budget looks a lot different than a line item or a performance-based budget. Line item and performance-based budgets are usually oriented around units and departments. So in a line item or a performance-based budget, typically, not always, but typically, you will see a budget for the police department, and then a separate budget for the fire department, and maybe a separate budget then for ambulance services or emergency preparedness. But the budgets will be delineated according to the unit or the department. And each unit or department will have their own discrete budget. Not so in program budgeting. In program-based budgeting, instead of budgeting according to unit and or department, we budget according to the program. So instead of budgeting according to the police department or the fire department, you might budget according to a program such as protection of persons and property. That's the program. Police services may contribute to the protection of persons and property, and certainly they will. Fire services will also contribute to the protection of persons and property. Now, ambulance services will contribute to protection of persons and property. So every single expenditure that contributes to achieving the goals of the program protection of persons and property will all be budgeted together, irrespective of what unit or department those services occur within. That's what's called program-based budgeting. So if you have a program-based budget from your city, you will know it because you'll look at that budget and you'll see it's organized according to program as opposed to being organized according to unit or department. One common strategy that a lot of governments will use in program-based budgeting is an approach known as crosswalking. And so in crosswalking, what they will do is they will create a matrix. And on one side of the matrix, they will have all of their activities. And at the top of the matrix, they will have their goals. And then they will see which activities contribute to which program goals, and then organize activities in that manner. So all the activities that contribute to this goal are all budgeted together under this program. All the ones that contribute to this goal are all then budgeted separately in a different category under this program, and so on and so on. So you can kind of see with the program-based budget, because you're budgeting according to program rather than unit or department, it allows you to see the cross-functionality. It allows you to see how all the different activities you're engaging as an organization will help you achieve different goals for your organization. So it is a very good strategic planning type of tool. And it's a good thought practice to go through as an organization to categorize spending around programs as opposed to units or departments. That being said, you're probably not going to see a whole lot of program-based budgeting used by local governments because it is a very time-intensive and resource-intensive type of process. It requires you to have a strategic planning process in place and then incorporate your budgeting within that strategic planning process. So it's much more likely you'll see program-based budgeting used at the federal level in an organization such as the Department of Defense. They've been using a variation of program-based budgeting since Bud McNamara in the 1960s. You also see it used in a few states around the country, much less likely to see it used at the local level. But it's a much more rational approach to putting your budget together. And then a fourth budget format that you may run into is what's called zero-based budgeting. Zero-based budgeting, like program-based budgeting, highlights that planning feature of the budget document. It allows you to plan out not only what you are doing, but what you could be doing instead. So in zero-based budgeting, what we do is we take a bottom-up approach to the budgeting process. So instead of starting at the top of our organization, we start at the bottom of our organization. So the first step in zero-based budgeting is to identify what are referred to as decision units. A decision unit is defined as the lowest level in the organization where budget decisions can be made. So you look at the lowest level in your organization where budget decisions can be made, and you term that a decision unit. So you'll probably have multiple decision units within your organization. So to give you an example, if you're going to do zero-based budgeting at Cal State Long Beach, you would look in the department, in the Graduate Center for Public Policy Administration. And we've got two separate programs. We have the distance learning program and we have the state supported program. Well, you would probably take those programs and say each one of those programs will serve as a decision unit. So the distance learning program will put together their own budget and then, or their own set of priorities, and the state supported program will put together their own set of priorities as well. So identify those as your decision units. Each one of those decision units will then create a series of what are called decision packages. Each decision package will put forth, here is a potential course of action, a potential way in which we can spend our money, and then here are some consequences of spending the money in that way, and then here are some alternative ways in which we can spend the money. So for instance, you might say for the state supported program, one decision package, we may say we could spend 5% more next year on faculty travel for professional development. If we spend an additional 5% next year for faculty development, for faculty travel, we'll be able to fund an additional 2 domestic trips for faculty members. So that's kind of the consequence of doing that. Well, instead, what if we gave an extra 10%? Well, if we spend an extra 10%, we might be able to fund 4 additional faculty members to travel to conferences. Well, what if we funded at 5% less? Well, then we may have to reduce faculty travel by 2 trips. But those are all the different alternatives, and then the consequences for each one of those alternatives. So you create all those different decision packages with your different alternatives and your consequences for each of those alternatives. Then those decision units, when they put together all these different decision packages, they will then rank and prioritize those decision packages, and then send the prioritized decision packages, all those rankings, up to the next level of the organization. So it might then go up to the department chair. Department chair would then take those different packages, would re-rank and reprioritize those packages, and then send their re-rank prioritizations up to the college. And the college would then re-rank and reprioritize, and then those highest ranked decision packages will then become part of the budget for the next fiscal year. But again, it's a very bottom-up approach where you're trying to include more and more members of your organization in the budgeting process. Now, the problem with zero-based budgeting is obviously it's very time-intensive and it creates sometimes a mountain of paperwork. Say, for instance, we use a really simple example, but say you're in a large organization and you have 100 different decision units. And each one of those decision units will be producing 100 different decision packages. You can see how exponentially the paperwork increases with the size of the organization. So the problem is it's oftentimes not practical to use pure zero-based budgeting every single year in every single organization. So what a lot of organizations will do is they will use a modified zero-based budgeting approach. And one way you can modify it is by only subjecting a percentage of your budget to zero-based budgeting every year. So a common approach is what's called an 80-20. So in an 80-20 modified approach to zero-based budgeting, 80% of your budget will be budgeted as you normally do with a line item type of approach. Very quick and very easy. But then you'll take 20% of your budget and you'll subject it to zero-based budgeting, a more rational type of approach. The next year, you'll select a different 20% for zero-based budgeting. And then in year 3, a different 20%. So that once you have gone through 5 years, you have then subjected your entire budget to zero-based budgeting. And usually we do have to modify it to make it a little bit more realistic. Zero-based budgeting started in the private sector. It started primarily at Texas Instruments. Former President Carter, back when he was governor of Georgia in the 1970s, brought zero-based budgeting into state government in Georgia. He liked how well it worked in the state government in Georgia. And then when he became president, was inaugurated in 1977, he then brought zero-based budgeting into the federal level of government. Problem was zero-based budgeting was not successful because it did create a mountain of paperwork. It works well for a small state agency or maybe a local agency. It's going to be a lot more difficult to do in a federal agency that employs tens and tens of thousands of people. So it's something that oftentimes has to be modified in order to work. Zero-based budgeting is used on a limited basis by a handful of states. Texas uses a little bit of it. Virginia uses a good bit of zero-based budgeting. And so it's something that some states use to some success, but it does create a whole lot of paperwork. For example, in the state of Virginia, they require their decision packages. Each decision package must be at least 40 pages, 40. So think about that. If you've got 100 decision packages, each one has to be 40 pages. You just produce 4,000 pages of documentation. And if you have 100 decision units, again, exponentially, you're up to 400,000 pages of documentation you have to review every year in your budget cycle. So it's not practical really to do it whole scale for all of your agencies and your entire budget, but a little bit of it does allow you to be a little bit more rational in the way in which you're doing your budgeting. It kind of requires you to go back and re-justify why you are funding these programs rather than just funding them because you funded them last year and the year before that and the year before that. So those are our four basic budget formats. Line item contributes to control, performance-based contributes to management, and then program-based and zero-based budgeting both contribute to more of a strategic planning type of orientation for your organization. Let me show you a couple of examples just so you kind of have an idea of what they look like and how they work. And actually, let me go ahead. I'm going to just share my screen so that I can cycle through all of them. So let me get through this. Okay. Let me first show you a performance-based budget and what that looks like. Let's see. Okay. Hopefully you can see this document I'm sharing now. It's called Department of Aging. Does everyone see that on the screen? Yes?
Yes.
Okay, good. Good. It's working then. Great. Oops. So this is an example from the state of Texas of performance-based budgeting as used by the Department of Aging. And again, I've got all these examples up on our Beachboard site for you to go and take a look at it at your leisure. So you won't spend a lot of time on it, but just kind of give you a sense of what a performance-based budgeting could look like. Here we have, for the Department of Aging, their mission. Department of Aging is the state's visible advocate and leader in providing for a comprehensive and coordinated continuum of services and opportunities so that older people can live dignified lives. So goal here is service distribution. And so the goal for service distribution to enable older Texans to live dignified, independent, productive lives within a safe living environment, so on and so on. You can read that. And here are some of the results, some of the outcomes we're trying to achieve. So percentage of the older population receiving services who are low income, percentage of older population receiving services who are moderately to severely impaired, percentage of older population receiving services who remained independent due to those services they received, percentage of nursing homes with certified ombudsman. So here are the goals that we're trying to achieve with the program. Here's the output that we are creating. So here's the number of hours for certified ombudsman. So here our strategy is provide statewide, locally based system connects people with services and benefits they need through ombudsman services, options, case management, information, and legal assistance. So what are we spending our money on? We're spending our money on certified ombudsman and the number of hours that we're paying for certified ombudsman. So our budget's going to fund 860 hours of certified ombudsman work. Number of persons who will receive options case management 8,730 people will participate in receiving options case management. Number of unlicensed assisted living facilities that we will identify. We'll identify 300 of those through the course of our work. How efficient are we being? Well, we look at the cost per certified ombudsman. How much is the cost per ombudsman? How much is the cost per options case management client? So we're going to break it down to those efficiencies on a per unit type of basis. For nutrition services, a similar type of thing. Here are the number of congregate meals we're going to serve with our budget. Here's the number of home delivered meals that will be served. Here's the number of meals that are reimbursed by USDA. Here are our efficiencies in terms of cost per congregate meal, cost per home delivered meal. You kind of get the idea. We're saying, here's the amount of money we're spending. Here are the specific activities that we're spending the money on. And here are the goals that we're trying to achieve by spending the money on these specific types of activities. This is a ton of information, more than you would have gotten with a line item budget. With a line item budget, you have just gotten maybe a line item for ombudsman, the number, and the amount that's being spent. We really don't have an idea of how that's then going to translate into the number, the percentage of people who are being served, the number of meals who are being served under nutritional services. You don't get any of that with a line item budget. You get those types of performance indicators, outputs as well as outcomes, with this type of a performance-based budget. So performance-based budgeting can be very useful, again, because it gives us the information that we need to better manage the operations of our organization. But what does this mean for you with your city? So when you're looking at your city's budget, what it means for you is when you're looking at that budget, do you see performance indicators? Do you see indicators of output? Do you see indicators of intended outcomes? If you see those types of indicators in your budget, then you probably have something that looks like a performance-based budget. There is no one type of performance-based budget. Different governments will organize their budgets differently. But if you see performance indicators of outputs and outcomes, then you can say you probably have a performance-based type of budget. But again, oftentimes what you will see your city do is they'll present a line item budget and then they'll break it out into performance indicators. And so it'd be kind of a hybrid line item, performance-based type of a budget. Now, if you have a program-based budget, you're probably going to be able to tell that pretty readily, because again, in a performance-based budget, it's going to be organized by the program rather than necessarily being organized simply by the unit or the department. Here's an example that I provided on the website that combines both a program-based budget along with a performance-based budget, because they really oftentimes work very nicely together. So this is a program/performance-based budget for the city of Sunnyvale, California. First thing you'll notice here under this budget is that we are budgeting according to programs. So here's the budget for program number 412. And program number 412 is for police services, not the police department, but for police services. So these are services that orient around police protection, protection of persons and property. So this is for a program. You'll then see for this program of police services, we'll have delivery plans. And so here's service delivery plan 41201, crime control and public order maintenance. Our goal is to provide a safe community and feeling of security among citizens by the protection of lives, property, and rights of all people, the deterrence and prevention of crime, the apprehension and prosecution of offenders, the maintenance of order and resolution of conflict, and the prompt response to incidents requiring immediate police attention. So that's what we're trying to achieve with this service plan 41201, crime control and police order maintenance. Here are the measures of our outcomes. So what are we trying to achieve? We're trying to achieve an average 7-year FBI crime index crime rate per 100,000 population that is 54% below the national rate, 63% below the California rate, and 38% below the county rate. So we want our rates to be below the federal, the state, and the county rates by these percentages. So this is what we're trying to achieve. We're trying to achieve average 7-year weighted clearance rate for crimes of murder, rape, robbery, aggravated assault, and burglary, 59% above the national rate, 66% above the California rate. So again, very specific types of goals that we are trying to achieve. So the question then becomes, how do we achieve those goals? We achieve those goals by spending money on specific activities. So what specific activities will help contribute to crime control and order maintenance? Well, we're going to provide police patrols. So activity 412000, provide police patrol. How many hours are we patrolling? We're spending this much money to patrol this many hours. Activity 412020, respond to non-emergency calls. So here's the amount of money we're spending. Here's the number of non-emergency calls we're responding to. Response to urgent calls, and so on and so on. Respond to emergency calls, provide police contracted overtime, provide prisoner transport. These are all the discrete activities that we are spending our money on, and we know what we're trying to achieve. We know what the effectiveness outcomes are for these activities that we are spending our money on. So again, if you can look at this as kind of a systems type of approach. So look at the approach of inputs going into activities, activities being conducted to then result in outputs, and those outputs then resulting in outcomes or consequences. It links your money that's coming into the agency with the consequences you are providing to your citizens as a result of the products and services you are creating with that money that you are spending as an organization. So it's really good to see it in that systems type of perspective, because it shows you where the money's going, how it's being spent, and most importantly, how well that money is being spent. So again, this is a program performance budget because it's organized around the program itself. You may see a program-based budget in your city. Probably you won't, but it's unlikely. But if you do, look for the organization of the budget. Is it organized around programs, or is it organized around units and departments? Organized around programs is a program-based budget. If it's organized around units and departments, it's probably either a line item or a hybrid line item performance-based type of a budget. Then our fourth type of budget we said was a zero-based budget. Now this is a little different in that with a zero-based budget is more about the process than it is the final budget document. And by that I mean it is possible that you may have a city that goes through a zero-based budgeting process, and that process then results in a line item budget. That is possible. So zero-based budgeting is a process you're going through. And again, with zero-based budgeting, you're identifying decision units who put together decision packages, and that's how you put your budget together. So you go through the process to then create the final budget document that may look very line item in nature. So the natural question is, how do I know if my city is going through a zero-based budgeting process just by looking at the final budget document? The way to know that is by reading the budget narrative or summary. Every city will give you a budget narrative or a budget summary. In that budget summary, you can guarantee that the city is putting the time and the effort into doing zero-based budgeting. They will tell you they did zero-based budgeting. No city is going to put the time and the effort into zero-based budgeting without bragging about it in their budget summary. So the city will come straight out and tell you if they use zero-based budgeting to put their budget document together. But the real backbone of zero-based budgeting is the creation of, again, of these things called decision packages. And here is a really simplified example of a decision package. This is very simplified. But in this example, we're looking for a library system. So I thought this was kind of good in keeping with your post-instructional assignment of looking at a library. This is a library system. So in this library system, they've gone through and identified their decision units. And one of those decision units they've identified is the Special Programs Office. So the Special Programs Office has now been charged with putting together a series of different decision packages. So here's decision package number 1, and it's the bookmobile decision package. So the purpose of this bookmobile and decision package 1 is to provide service to remote regions served by the library, enhance the quality of life for the county's homebound and senior citizens or citizens without access to transportation. So obviously we got this bookmobile. We're going to be mobile. We're going to take the books out to the people because they cannot come to the library. So for this decision package, we have 3 different alternatives. Alternative number 1 is to fund the bookmobile at 90% of base. So 90% of what we are currently funding the bookmobile at. If we fund it at 90% of what we're currently funding it at, we can fund 25 hours per week at a cost of $36,000. A second alternative is we fund it at 100% of the current level. So we keep doing what we're currently doing. That means we can fund 30 hours per week for the bookmobile at a cost of $40,000. Or we can enhance it by 10%. So we spend 110% of what we're currently spending, an additional 10%, is you get 35 hours per week and at a cost of $44,000. What are the consequences? The consequences are if we choose the reduced funding amount, it means we're going to have lower circulation rates among our elderly library patrons. So that's what happens if we choose the 90% as opposed to the 100 or the 110%. Well, are there any other alternatives other than a bookmobile? Well, yeah, we could use a van service, but the van service has exorbitant insurance costs. So we rejected the van service and we're choosing between these 3 different funding levels, 90, 100, or 100%, 110%. So since the consequences are reduced funding means lower circulation rates, chances are this decision unit is probably going to promote either the 100 or the 110% as their chosen decision package to send up the ladder of the library. Now, library organization chart. Now, as it gets to a higher level, then managers will decide whether it's more important to spend more money and have higher circulation rates or spend less money and have lower circulation rates. And then that will be a re-ranking and reprioritization up at that higher management level. Here's another decision package for in-school programs. So for in-school programs, the purpose is to encourage library use among grade school students and to enhance existing library programs targeted at low-income neighborhood schools. Again, your 3 funding levels, 90, 100, and 110%, and the activity levels. Consequences of the reduced funding level affects literacy effort and may affect standardized test scores. The alternative was an after-school program at the library, but again, if you're going to host it at the library, you've got staffing costs, you have insurance costs. They were cost prohibitive, and so that's why we're looking at this in-school programs alternative, selected between the 3 different funding levels, and so on and so on. And you'll see that goes on then for foreign film series and so on and so on. But just give you the example of this is what decision packages look like. We rank them, we prioritize them, we then send them up the organizational chart. Then the top ranked, top prioritized decision packages, those are the programs that then get included in that organization's budget based upon the amount of revenue that is available to the organization. Again, this is very simplified. Like I told you, in Virginia, their decision packages are a minimum of 40 pages, and so they get much more complicated than this, which just kind of gives you an idea of what zero-based budgeting is and how zero-based budgeting works. Now, again, my sense in doing this for many, many years, I mean, I've been teaching budgeting here in Southern California now for 22 years now, I guess. You usually see line item performance-based. That's usually what you see local governments use. And I'm sorry, I was neglecting text. Yeah, California line item budget. Yeah, California uses primarily a line item budget. California does have a provision, though, where a certain percentage of agencies will need to go through a zero-based budgeting exercise every year. So there's a very small sliver of zero-based budgeting, but the vast majority of the budget tends to kind of adhere to that line item type of approach. With this type of budget with programs, as a group somehow measured the outcomes. Program-based budgeting will have outcomes that are part of that program. So here are the programmatic outcomes and how we're achieving those outcomes. The problem you run into, it's a good point, the problem you run into with program-based budgeting is that you have program outcomes, but sometimes departments want to have their own outcomes. They have their own departmental strategic plans. So the departments tend to be somewhat resistant to budgeting in a program budgeting approach because they want to have their own budget that contributes to their own departmental outcomes. That's one of the reasons why program-based budgeting was so heavily resistant at the federal level. That's when it was brought into the federal government in the 1960s. It took hold of the Department of Defense with Bob McNamara when he was Secretary of Defense. It didn't take hold in a lot of other departments and agencies because they really felt they wanted to have unit-specific budgets as opposed to budgeting everything together within these overarching programs. You can think, from the local level, if you've got a police department and a fire department that are both city departments, think about some of the conflict you would get if you tell a police chief, you're going to have to budget within this program, protection of persons and property. You can no longer have your unique police department budget. You're going to have to budget together with the fire department. You're probably going to get some pushback from that police chief. And there was a lot of pushback from agency heads who didn't want to do this type of program-based budgeting. So that was some of the problems with trying to do program-based budgeting on a whole-scale approach across the entire governmental level. But again, where you see these budgets, usually the rule of thumb is as you move down intergovernmental levels from federal to state to local, your budget format tends to become a little bit more simplistic. So at the local level is where you tend to see mostly line item budgeting with a little bit of performance thrown in. At the state level, that's where you're going to start to see maybe a little bit more program-based budgeting, and for a few states, a sliver of zero-based budgeting. For Virginia, almost all zero-based budgeting. At the federal level, we see a lot of performance-based budgeting with those performance activity reports, a little bit of program-based budgeting as well, very little zero-based budgeting at the federal level. We don't see a whole lot of zero-based budgeting regardless of what intergovernmental level you look at. But typically, as you move down intergovernmental levels, you get a little bit more simplistic because you oftentimes don't have the professionalism, the expertise, and certainly you don't have the resources and the time to devote a whole lot of energy to putting your budget together. You're more focused on service delivery to your citizens because you're involved in direct administration at the local level. The federal level is much more involved in indirect administration. And so they don't have to be all that concerned about providing those services on a daily basis to their citizens as local governments do. They can spend more time talking about the esoteric nature of budgeting as opposed to their local level counterparts. Again, I've provided these examples and a few more up on our Beach Board site, so you can feel free to go through those a little bit more in depth to help you identify the type of budget format that's being used by your city. Again, take a stab at it for Beach Board number 2. I do ask in Beach Board number 2, whenever you tell me what budget format your city is using and suggest an alternative, at the end, could you just put a link to your budget in your post? I could just click directly on that link and go and take a look at the budget and give you some feedback as to whether or not I agree that's a line item or a performance-based budget. But again, for most people, it'll probably be primarily line item with maybe a few performance elements mixed in. Okay. So those are our 4 budget formats. Any questions on those 4 budget formats or identifying the format for your cities? Again, if you've already turned in your pre-instruction and you said, I don't have the information to answer the question, that's absolutely fine. Because you certainly didn't have the information then. We didn't go over the information until tonight. So no need to resubmit anything. You're good if you've already turned in your pre-instructional. Also on our Beach Board site, in addition to those examples of budget formats, I also have some links up there for the federal budget process and the California state budget process. So you can go and take a look at those links. Again, they just kind of provide you what we talked about in terms of how the processes work and some of the steps and the stages in the processes, just so you have an idea of how budget processes work. Where budget processes will be important will be more on the on a assessment, a final assessment, as opposed to in your pre or your post-instructional assignments. Okay. Any other questions or comments or anything on any of this material? I know I talked a lot tonight. I'm sorry for that, but we really had to get through this information since we didn't have class last week. Hopefully I won't talk quite as much next week. We'll see how that goes. But so I apologize for all my long-winded discussions tonight. If you have any questions of this material as you review it, feel free to reach out, shoot me an email. Any questions on Beach Board essay number 2 or the pre-instructional before it's due on Sunday, feel free to send me an email. Otherwise, next week, what we will do is we'll again break the session up into 2 sections. The first part of the class, we will talk about analysis and budgeting, and I'll organize that discussion around the purposes that we analyze budgets for. So say how we analyze budgets to forecast revenues, how we analyze budgets to estimate cost, how do we analyze budgets to determine how much of a quantity to produce, how do we do it for growth rates and for projections. We'll do it according to purpose. So we'll go through all those different uses of analysis and budgeting, and then we'll take a break. And then the second half of class, we'll do capital budgeting, and we'll talk about the use of debt and the different types of debt that we use to pay for construction projects. So kind of a 2-part class for next week. Then the week after that is when we'll start getting into revenue and taxation. And then we're almost done because it's only 6 weeks. So it goes by real fast. Okay. All right. Well, thank you very much for being here tonight. I'll have the recording up for you by tomorrow morning. Have a good week, and I will talk to you again next Monday. So take care, everyone.
Thank you, David.
Thank you.